So I've made some big changes in my dividend portfolio. The one that I want to get to 1 million by the time I'm 50. And I've sold 3 stocks. They're quite obvious in why I sold them, and I'm going to explain in this video, but I've also added 2 more, and I'm looking to add a couple more to it to make it a little bit less risky of the overall portfolio pie. But by doing this, it has sped things up a bit, which I will reveal in this video, but I'm also going to be showcasing that I am going to be investing in August quite heavily. But I'm also going to break down the goal and why that's changed and why that passive income side of it sped things up massively. Even though in the comments I've been listening, I've been looking at what people have been saying, and yeah, I have made some changes and I've added a couple bigger yield elements to it and looking to add even more. But as I say, make sure you do watch to the end, and I will showcase my projected yield, my overall growth metrics of this portfolio, and where it could be going in the next couple of months, and hopefully gets more aggressive. And if you're following along with the journey and you're enjoying it, leave a like. It makes a big difference. So a quick recap: if you're new, hello, welcome. And if you're like, oh, I've missed the other episodes, doesn't matter, I've made some changes, we're going to go through them, okay? So the goal is £1 million in the ISA at some point in the next 14 to 15 years, potentially. Fingers crossed, right? And the starting capital, we're roughly at about £55,000, £56,000 at the minute. And I'm looking to add £20,000 per year. It's all based off dividend growth. It's all based off income. And I want to use that income to reinvest, compound, and get growth dividend stocks to enable that to happen without, the withholding tax of 15%. So I'm not using any US stocks, just UK only. But I am a crypto investor. You probably see by the stuff in the background. I'm cryptocurrency through and through. I have been since 2016. And that is my full-time situation in terms of income mainly. So I'm covered with the risk there. So you don't have to worry about, you're not doing much risk. This is diversification for me. And it's also a bit of a fun challenge to see what I can do with consistency and time. So yeah, we'll get into it now. By the way, for a brand new channel, for me to achieve this with zero footprint in terms of my other niche of crypto, most people hate dividends in crypto. It's really funny. To find some love here has been really nice. So I do appreciate it. So I have taken a fair whack with Greg's, which is a bit frustrating. It happens, unfortunately, and it's a solid business, but it's getting raided by shoplifters. The yield, though, you could argue a bit topsy turvy with potential reductions in coming here. And I know that's quite speculative to say, but I do worry that their profit margins have taken the worst hit since the pandemic. So yeah, that's a bit of a situation we need to look at. And the reason why I say that is because when you do go into the dividends, yeah, it's been okay. But as I say, their news and what's been happening, they're blaming the weather. And I've mentioned this before in previous videos, there's been massive decline in profits. And that's the situation. Even though the fundamentals are pretty optimistic, the fact that they had to close stores in winter because of the weather, and then obviously in the summer there's been a heat wave and no one's been buying into their stores, it's a bit of an issue, and we can't really have that in terms of a solid portfolio. Like, everyone goes to Tesco, for example, whatever the weather. Why not Greg's, for example, right? So that situation kind of worries me, and it does worry me that maybe the dividend side of it may well drop in terms of the overall side of it, in terms of the growth. And you can see here, it's quite cyclical, but it kind of worries me that we may well start to see a bit of a drop off in the yield here. As you can see here, yeah, this could be fun. So it kind of worries me a little bit that we could be seeing a bit of a drop in profits over the course of time. So that equals, obviously, more importantly, price performance, and the price performance of Greg's has been awful. Another one is SPX, Spirex Sarco. Now, on the whole, it's a good stock. It's paid its dividends for a lot of years, but you could argue it might be still expensive, even though, you can look at this chart and think, you know what, dividends are all right, payouts are all right, growth all right. But the situation is actually this: it's dropped quite a lot. And you can argue, when's it going to fall? Where's it going to fall down to? And even though I made a slight profit on this and I have taken my money and ran a little bit, I didn't really want to get into a trap where it's going to fall more, because over the last 5 years, it's been pretty horrible. And even in the last year, it's down quite a decent chunk. So that kind of worries me. And I thought, no, dividend yield's only 2.56% roughly at the minute. So that kind of worries me. And as I say, you don't want appreciation of 30-40% down in a year. And another one, somewhat similar, is Bundle. It's reliable, don't get me wrong, and it's got good dividend yield and stuff like that, but it lacks that kind of punch with certain things. And the one thing that really dropped the price in this over the course of that time was tariffs. So North America, there was a lot of their companies based out there. It took a massive hit. So That kind of worried me, even though the dividend yield is okay. And as I say, the dividends are actually relatively good and you could argue pretty safe. The fact that it dropped 30% overnight, no, thank you. So I don't want to be involved in assets where we could get real big jeopardy. So, which is why two of them are obvious. Greg's, as you can imagine, shoplifted, all kinds of good stuff around that, which is negative, obviously. And then you got obviously this side of it with tariffs. So, yeah, interesting. Now, my new purchases, a bit more excitement. We have a decent dividend yield with the City of London Investment Trust. Now, some of these stocks within this trust I actually hold, which makes it a little bit better. It's got good diversification income. It's solid dividend history of like 40 plus years, I believe. And it's got a good base layer holding that is quite solid for a portfolio. So I thought having a trust fund in there kind of mitigates a bit of that, volatility risk that I was just talking about. So that is pretty huge in itself. But for me, fundamentals are quite key here. We want something that's quite steady, as I say. And over the course of time, their performance has been really, really good. And the dividend yield is held up. And obviously, what they're holding is pretty good. So even if I was to like look at buying portfolios around this, I already hold Shell, I already hold BAE Systems, I hold Relics, I hold Unilever, which isn't the perfect one at the minute, and Tesco. There's a couple of others that are not holding on there. So there's a bit of a exposure there. So this one kind of makes sense. And as you can imagine, the dividend yield is 4.29%. So already it's looking pretty nice versus some of the ones I've already sold. And the other one that I've bought into is Phoenix. Now, I covered this on one of my videos not too long ago. Had a pretty rough 10 years, realistically. Now it's starting to bounce back. They've done some changes and the dividend yield is over 8%. There is risks here because it is quite high, and I don't like high risk, ballsy kind of moves. But at the end of the day, I've got to have a balanced portfolio where some of them are quite low and some of them are quite high. The average on that side of it's quite good. But overall, you could argue this is undervalued because it has been performing pretty badly. But as you can imagine, part of Sun Life, Standard Life, all that kind of stuff around pensions and death, sorry, it's quite an important sector and something that I kind of needed exposure in. So this one just made absolute obvious sense. And even if you're looking at overall the results and the performances and stuff like that, it's actually been pretty good. Um, you can argue the cash generation pretty good, operating cash, the dividend share has increased, all that kind of stuff has been fantastic. So I can't really see any fault with it at the minute. Personal opinion, it's obviously risky, but as a sector, I kind of needed it. Now, another sector that I do need is Hikma. We're going to talk about some of the stocks that I'm looking to add now. There's about three of them I'm looking to add, and this is one of them. It's defensive healthcare play, Hikma Pharmaceuticals. I can't even say the word. Dividend yield is about 3%, just over 3%. Its dividend growth target is really solid, though. It's like growing really nicely, and it's got consistent growth with some margin expansion, and it's actually doing pretty well in terms of price. It's not amazing, but it's actually relatively steady over the course of time, so it's not too bad. So this is a really obvious, solid one in my viewpoint. In terms of the website, it's pretty neat and tidy. It tells you exactly what you need to know. And even on the investment side of it, recent results, why to invest and stuff, it actually fills you with a lot of confidence in terms of how many like leading, like seventh in the US, stuff like that. A lot of plans here, global player in, local expertise and the overall core revenue. All of these tick a lot of boxes. And it makes you think like this side of it in terms of strategic element around growth, diversification, people responsibility, all that kind of good stuff. Now, what I will say is this, there's always a grey area around obviously medicine and healthcare. But realistically, if the numbers are good, it probably is good. If they've got the fundamentals to kind of grow and they are looking to expand, which is pretty key. And even here, products in the pipeline 300 plus, launches across our market 132. It's definitely doing something useful. Now, another one that I'm looking to add is Games Workshop. I've seen a lot of people comment this on the YouTube channel, and it's got a unique IP, obviously. It's got a global cult following with Warhammer, and that is actually going to get released onto Amazon very, very soon, and that's important. And dividend yield, 2.49%. It could be a bit higher there, but overall, their growth cargo as a company has been pretty solid over the last couple of years. And, it has petered out a little bit here. But realistically, I'm just looking at the appreciation here because if Warhammer is successful on Amazon and then that leads to a new generation of people going into these shops, it's just going to grow and grow and grow. So it's one of those ones where there's a little bit of cyclical risk here, but there could be an incredible return on investment, sorry, and also, reinvestment of dividends because they are pretty good with their dividends. They've actually given out quite a lot of money recently to a lot of their investors. And another company that I'm looking to buy is Hilton Food Group. They're pretty normal in terms of like M&S and Tesco supplier. They've got a decent dividend yield, which I will go through in a second, but it's slow and steady growth and a quiet compounder in obviously food packaging and meat supply, which is kind of what we need in the UK right now. Price performance year to date, not amazing, but could be a lot worse. I've seen worse than this. But overall, dividend growth, their yield is over 4%. It's pretty steady away, and it is, as I've mentioned it, it's a steady compounder and something within the heart of the UK that we do really need. Not to mention growing financials. So yeah, it's ticking all the boxes. And these three that I've just mentioned, they will reduce the overall risk of my portfolio. They give it a bit more of a rounded kind of element, and they do add, in my opinion, some new sectors that I don't have. For example, Games Workshop is a pretty unique one, but more importantly, you got healthcare and obviously you got more consumer goods here. But please do let me know in the comments what you guys think. Which one would you go for? I'm looking to probably add two of the three potentially here, but maybe all three. Depends on how much I invest. So with the stuff that I've already added, which as you can imagine is only the two right now, and I've removed some stuff, the annual revenue has increased quite a lot, and we've also got an extra couple of percentage on the yield right now, 3.21%, which is much higher than what it was. And that's a really, really good thing. And as you can see here, right, when we talk about dividends and we look at the overall metrics, over it, 3.31% is the yield on cost. Even though I've only been holding this portfolio for 6 months, essentially, realistically, it is starting to grow a little bit here, which is good to see. Now, as you can imagine, yes, diversification of income, quite a lot of it is with Phoenix Group because it's got the highest yield, and with the other stuff, it will kind of rotate round, which does make it quite nice. But overall, it's looking pretty nice, which is what we want to see. In terms of the dividend calculator, as you can imagine, yeah, the annual income's pretty nice, and the overall yield's quite nice, the daily income's nice, and even going into the future here in 2026, it's looking pretty decent. And there'll be some pretty big, heavy months in, next summertime, which would be great for compounding. And as you can imagine, this number will be different because I have even more in my portfolio because I'm going to be reinvesting. Now, as you can imagine, you all want to know about my goal, and this is currently where we are right now. We're actually achievable in 14 years now, which would put us pretty much perfectly in line and maybe a bit earlier if we are going to continue with reinvesting dividends, putting the £20,000 in every single year, and more importantly, hitting this return rate, which is actually relatively good over the course of the time. And as you can see here, it will start to compound pretty bloody aggressively. And that's just value appreciation. Even with the safe scenario, it's actually looking really neat and tidy, especially if you're thinking 10 years down the line, you could have like over 500,000, which is amazing. But it's all about those dividends. Are they going to remain? Are they going to continuously grow? What's going to happen? And the thing is, I hate chopping and changing. I don't want to do videos where, oh, I'm selling stocks. Wanted to nip it in the bud early just because of the fundamental element around certain things around life. Yeah, Greg's might be absolutely fine, but I don't want to see the price nosedive 20, 30% every single year, and then eventually it bottoms out and then I've lost a lot of money. That's not the game we want to play here. We want something to be stable. We want it to like not wake up, be like a cryptocurrency portfolio and you've lost 30% overnight, right? So that sort of situations here. But for me, this is looking much healthier, and you probably will agree with me in the comments, hopefully, fingers crossed, because it has actually taken a bit of a jolt up. Now, again, if we look at this in terms of passive income side, now, whether it is 50,000 a year, whatever it may be, we are looking at certain situations where by the point of when this whole portfolio is pretty much at the end of it, we should be looking at around 25, £26,000 per year as income when we hit that lofty target. That's the goal. Now, yes, I know £1 million for some people isn't a lot of money these days, and I know it isn't. But the reality is that will automatically grow for me, and I don't have to reinvest myself because that will take care of the business and I'll reinvest the capital. Or I can just step back, walk away, and go, right, I can just live off these dividends and have a bit of fun in life, realistically. So there's too many variables and things obviously to look at now, but overall the dividend growth is 2.77. 3.21% yield currently right now, and that yield on cost will increase as time goes on as I hold these assets. But yeah, these changes are all about balance, and understanding the balance of that is important. And I know everything can change in a sixpence, but I'm aiming to just kind of somewhat accelerate that income a little bit, but stay diversified, but hopefully hit that tax-free goal while hoping that the UK keep the ISA platforms as they are, or hopefully increase the amount that you can put in them. I know everyone's different, but I would like to know in the comments what you guys all think about those assets that I've removed, more importantly, ones that I've added. But yeah, I know everyone's in a different situation around reinvesting dividends or if they're going to go for growth stocks or ETFs, and there's different content creators with different opinions. But for me, I do like the idea of like individual kind of stocks and seeing how they do because you have more control. And yes, you could argue a couple of things. And even if I go over to my trading 212, I've still got £12,100 to play with. And this is a thing. I'm looking to add. So I'm probably looking to put about £2,000 or £3,000 in August, pretty much, because why not? I can afford to do it, so I might as well do it. And this is a situation we've got to look at. When we talk about dividends and reinvesting, yeah, let's go for it. Let's put them in. But ultimately, the risk side of it is what kind of worries me about this whole entire portfolio because even though I've only got 15 assets currently, some of these percentage levels are pretty high. I want to kind of diversify that a little bit so it's like down a little bit, if that makes sense. So if one of them does obviously go bust or something, I'm only going to lose a little bit less than that. But it's all about diversification. Some really solid stocks here that I really, really, really like. And I want to keep them for a very, very long period of time. And they're all doing pretty well over the most part, anyways. But the reality is here, we just don't know what's going to happen with this market. And that's where the jeopardy comes in, which is why my opinion is dividend growth and getting those dividends and reinvesting those dividends are amazing because even if the stock prices do go down and you get paid, you reinvest it with this platform here, as you know, Trading 212. The pies are really good because if you start seeing certain things go a bit crazy in terms of profit, and I've already done this before, I've taken some profit out of some, I've moved them to the lower ones as well. It does majorly, majorly help. And I've seen it before with bounces. It's really, really handy. So yeah, just keep your eyes on what's happening overall in the market because you just never know what's going to happen in 2 or 3, 4, 5 years if you're holding them. So there we go. I'm going to put £3,000 in roughly, I'd imagine, over the course of August. You know, I'm looking to add some more stocks and there will be further updates as we go. But yeah, if you enjoy this sort of stuff, follow along in the journey. At the minute, I'm still in the building phase. I'm looking to kind of stay with certain stocks, and some stocks are doing fantastic, as I've mentioned. But the reality is here, there's a long way to go.